Hi there, Michael McIver here. Today I'm going to show you how to use the new T1 method for calculating a net surplus or deficit of income using a rental property that has been owned for over 2 years, is declared on the tax returns, both income and expenses. Now I'm assuming an arbitrary scenario here with a mortgage amount of $500,000 with a rate of 3.75% amortized on 35 years. That was purchased through a CMHC small rental program just over 2 years ago with 5% down. Okay, so the total mortgage amount would of course include the CMHC capitalized premium and be $534,500. So that means the CMHC premium obviously $34,500. I'm also assuming here in this particular scenario that we are generating $3,500 per month on this property for an annualized total of $42,000 per year. I've also assumed no vacancies in this particular scenario. So just make note over the course of this example, and we can revisit it at the end here. The principal and interest payments on this loan amount would be $2,278.03 for an annualized total principal and interest payments of $27,336 per year. Now, regarding the T1 method in determining a net surplus or deficit, we go by what we are able to write off on the T1s, which in all cases is interest on the mortgage. In this case, it's $19,473.84. A CMHC premium, we are able to write off 1/5 of it each year for 5 years. If you sell the property in under 5 years, you write off the balance of the premium in the year that you sell it. Of course, we have taxes here of $300 per month, I'm assuming, $3,600 per year. Legal fees, which fall into the same category as the CMHC premium here. We can write off 1/5 of it each year over the course of 5 years for $200 per year. A maintenance amount, I'm assuming for our purposes here it's 10%, so $4,200 per year, but in reality this is going to be an actual amount, okay? So it's going to vary from property to property. So it really boils down to how your client is going to be managing their investment property. And vacancy is not really something that we can account for on the tax returns, of course. I've just put it here just to kind of make a point that we don't account for it, but we do take into account this particular item in the 80% offset method. So our expense total here is $34,373.84. This is the total of all the items up here that we've declared on the T1s, and our income generated is $42,000. Now at the end of the day, in this particular scenario, we would have a net of $7,626.16. Now keep in mind, we haven't taken into account vacancy. We're also not taking into account a principal amount in this particular scenario. But what this $7,626 does tell you is that you have a little over 2 months of vacancy that you can account for, assuming that we are getting a rental amount of $3,500 per month. Okay. Alternatively, you can look at it like an expense account. So if your client needs to know how much they can spend on expenses, i.e. painting the exterior of a house or rentals or anything like that with respect to their investment property, this is how much leeway they have before it starts to become a deficit, and they will have to debt service it in the qualification process. Okay, now if we compare this directly to the 80% offset method, of course, pretty straightforward. We're just looking at the total of the monthly payments, P&I per year, $27,336.36. The total taxes, of course, per year, that gets factored in, so $3,600 per year. A 10% vacancy, or sorry, pardon me, a 10% maintenance amount for $4,200 per year, and a 5% vacancy amount per year. Standard stuff for any DCR spreadsheet that you are going to get your mitts on. So we have a grand total here for expenses of $37,236.36 using the 80% offset method. But remember, we only get to use 80% of the rental income. So 80% of $42,000 is the $33,600 here. So in this case here, you would actually have a deficit, okay, of $36.36 per year. So your client would actually have to debt service a monthly liability amount of $303.03. Okay. So the T1 method really rewards clients who have been managing their properties diligently, like a business, and declaring it on the tax returns, and becomes a much more powerful tool. And if you are managing your properties diligently, imagine what sort of effect this has once you start to own 2, 3, 4, 5 properties. The effects just compound. So that would mean in our particular scenario above here that we would have an additional $635.51 a month to play with, really, or leeway that we could take in less rental income, or maybe we could use for expenses, and the property would still be a wash. So once we've determined the net surplus or deficit and how we're going to use it on the application, in a nutshell, we can basically reduce all the property income and expenses to $1 in expert. Of course, the property details will still remain the same in expert, but the relevant details will show up on the T1s in the statement of rentals. And of course, if there's a surplus, it gets added to the applicant's gross income, and of course, a deficit will be debt serviced in much the same way an unsecured monthly liability would. And that is how you use the new T1 method for properties that are, or investment properties that are owned over 2 years and are declared